Hey everyone, me Kevin here. Well, I've got another busy 5 days of flights ahead of me, and wow, we've got some HouseHack updates. First of all, we are getting to that phase that my team tells me is exactly what we predicted, okay? We are at that place where people's loans are coming due, they're going into foreclosure on some multifamily deals, it's happening, and people are calling us to try to solve their problem, which is really exciting because it's turning into a pretty juicy opportunity to buy multifamily real estate, single family real estate. And it all goes in waves, right? Single family had a really good buy period in October. In November, it became less desirable to buy single family so far the last 2 weeks of December and early January, mostly because the inventory falls off the market at the end of the year. You wait for the new listings to come on. Very seasonal, very normal in multifamily. Almost true in every market we're looking at. But multifamily, Fannie Mae is tightening the screws on a lot of these building owners in default. And so they are motivated to sell deals. We just closed a it was a deal listed for $18 million that we closed for a good chunk under 16. We've just also won an auction on another deal that's an 8-figure deal. That's actually in a market that, once we stabilize this building, might be somewhere between a 7 to 9 cap. So that'll be interesting to see how our DD continues on that deal. But this is fun. We are really building this company out really, really well. And we're setting it up in such a way where we want to balance. We want you as investors, first of all, to know that we can do single family wedge deals all day long, and we're doing them. We're not overpaying. We're refusing to overpay. When the numbers make sense, we buy them. When they don't, we don't. We've got an amazing construction team that's coordinating our renovations, so we're doing fantastic on those renovations. I'm actually surprised how well we're doing in the different locations that we're in, and the support team, the relationships that we're able to build with other vendors, amazing. We're building our property management division since we've got a lot of tenants now, and we've exponentially grown the number of tenants we have from no tenants to 2 tenants to dozens of tenants, and it's about to be in excess of 100 to 200 tenants, which is wild. So the property management team is learning all the ropes. I'm teaching everything to where our accounting team can run things the way I like. Our property management team can run things the way I like. Construction team, whom I've been working with and training for the last 8 years, basically, can run things the way I like. And so it's really coming together. It's pretty exciting. Now, there are going to probably be growing pains as we start closing these deals and taking over all of these keys, so to speak, to doors. But it's fun. I don't think I finished the thought on it, but on this deal we just, the first multifamily building we just closed, we had a $200,000 commission check, and I wrote the transaction deal, and I promised HouseHack to give every penny of that commission to HouseHack, so we're looking at it as basically off the price on HouseHack, which is great. So obviously we'll handle that from a tax POV and everything, but the entire check is written over to HouseHack, which is exciting. So we are building a property management, multiple different areas. We are still waiting for California to license HouseHack as a real estate brokerage. I applied maybe 8, 9, 10 weeks ago at this point. I think they're like 2 or 3 months behind on processing these, but they cashed our check like day one. They still do paper applications and mail check, but whatever. So eventually that'll get processed. So right now, when we're writing deals, I'm writing the deals as the broker, and just whatever commission I earn at HouseHack gets. I have not taken a single dollar of commissions from HouseHack. I have not earned a single dollar of commissions from HouseHack, and HouseHack has not paid a dime of El Plano. I'm going to be very clear about that because I know those questions come up. So frankly, it's exciting. Like, this is fun. This is what I've always dreamed of doing, is building a company that can, quite frankly, start relatively close to a recessionary era and then basically make money solving people's problems. And they're big problems. They're headaches, but that's okay. We're getting paid for doing that in the form of great deals, right? So this is very exciting. We will probably, though, because it's going a little faster than we thought in terms of how many good deals we're coming across, and this is underwriting rent discounts into the deals. Like, we're looking at deals going, okay, we're going to assume rents are 20% less. We are underwriting based on a 20% reduction in rents, and we're like, the deal still works. Like, well. So, kind of wild, not so scary, mostly because we think there's an appetite for this, but there are not a lot of people with an appetite for this. So I'll give you an example of a deal structure. So seller will say, hey, look, I've got financing. I'm going to make up these numbers, okay? So I've got financing at 9 mil, but I've borrowed an extra 6 for other projects. My notes are due on the other 6 mil. I'm in default. I've stopped making payments on the assumable first. You could assume the loan at 3%, but I need cash to cover the rest. We go, okay, we'll underwrite the deal. We don't care what the debt is. We'll underwrite the deal where it makes sense. And if you can strike a deal at that number, great, we'll go for it. If you can't, we won't. It's that simple. And we're just finding more often that people are accepting our deals, which is, again, very exciting to us. I think the biggest risk we face in multifamily is, quite frankly, overbuilding, which will drive rents down. And I think this is the way we're parsing it out, in high construction areas, easy to build areas, you want to go lower income, because I think we're going to see joblessness. We're going to see a collapse of incomes, and people are going to get squeezed into smaller, less expensive units, hopefully with good management. That's another thing, by the way, we're finding is people love our management so far. Knock on wood, we can keep it that way. But we're getting comments from tenants like, here's one I wrote down. You are already 1 million times better than the prior property manager. Thank you, thank you, thank you. Like, these are the comments that we're getting. Pretty exciting. So, but anyway, yeah. So going back to this build issue, in markets where it's easy to build, like let's think South, Texas, Florida, Tennessee, Vegas, Arizona, easy to build markets, we think you're going to see rent compression as more new units come online, and you see rent compression. So you need to price that into your deals. We think there will be less rent compression in hard to build markets. And we like a balance. So diversity. We like single family wedge deals. There haven't been that many in the last 3 weeks. There have been plenty before that. Like, we did great when they were available. Now there are less. There will be more available come the springtime. That's normally when sellers sell. Yes, there'll be more buyers, but we can beat other buyers. That's no problem. So we'll have our single families, then multifamily in low build areas, and multifamily in higher build areas. Multifamily in low build areas, you usually want higher income. Multifamily in high build areas, you usually want lower income. So that's sort of a criteria, right? There's obviously also a limit to how much I could say right now. I know people are like, what are the rents? What are addresses? All of that will come. Probably more like Q3, Q4 of this year, and it'll just be full, here's everything, right? We just hired our auditor for completing our last financials, which would be our 2023 financials. And those will be out in April. And then our next financials, which will finally start showing some multifamily, will be out probably around the middle of July. But again, right now we're building a company anyway. So I think what we're going to find is that I'm projecting our OpEx is going to be high as you start the company. But that's the same thing as like building a factory, right? You build a factory, your OpEx is high at first, and it scales as you actually add units and property management and income. So obviously we want to get to that scale as soon as possible, but we also don't want to burst at the seams. We're not close to that. I purposefully overhired, knowing that very quickly we're going to be at a state of underhired. I think that's going to switch very, very quickly. Anyway, so that's where we stand with acquisitions, market mindset, auditing. We have a lot of opportunities coming to us with defaulted loans that we could actually pick up and bring current with like 3% debt, which is fantastic that we can assume loans like that. So that's pretty exciting. As far as warrants, we'll probably call warrants due. We're expecting probably somewhere between $13 to $17 million in warrants. We'll call those due maybe within the next 2 weeks, which means you'll have 60 days starting in 2 weeks to either execute on your warrants or you lose on those. If we do another fundraise, it will not be at any valuation lower than 1 to 1.5. And I still think that's a deal for what we have. Now, obviously, that's my opinion. This video is not a solicitation. Let's be clear about that. This is just an update for existing investors. But we're looking at, I mean, honestly, I just opened this up. I'm like, this is so crazy. There's a company that's like, oh, credit card for tenants or whatever, right? $3.1 billion valuation with a $200 million equity round. That's literally like $100 turning into $6 of cash value and roughly $94 of brand and company value. At a 1 to 1.5, 66 out of every $100 are going straight into cash at the company, and $34-ish are going into the company and brand, which is like, it's still such a crazy good deal, in my opinion. Investing in startups is risky. We obviously have to balance that, put the glasses on and the darkness. But again, this is not an ad video. This is just an update video. Okay, so we touched on our tenants love us. There are so many deals. There's no shortage of deals. It's just a question of how good of deals can we get right now. It's kind of scary in a really good way. Like, I'm excited about it because I'm already discounting for the potential for a Q2, Q3 recession. Income's getting squeezed, income's coming down, and wanting to be positioned ready for that. So we're underwriting to that already. Foreclosures, ADUs, big deal in certain markets. We can do that on multifamily too. Don't tell anyone. There's a big opportunity there, okay? Auctions, foreclosures, off markets. We're doing all of it. Oh, we updated the website a little bit. This is not really like practically being used right now. In the longer term, it will be. But we're kind of just building this out where it's kind of like we basically say we could pay more than Open Door. So and people have already started doing this. They send us their Open Door offers. You see, why HouseHack often pays more. Our costs are lower than Zillow, Redfin, Open Door, Flippers, or whatever. So we ask them to basically send us their Open Door offer, and then we underwrite and we're like, can we beat that? And sometimes the answer is yes, we can. So that's pretty exciting, sort of trying to leverage off of their marketing. I'm also now utilizing this eHack style investor update page. So you could just go to househack.com and click investor updates. And so after I post, or while I'm uploading this video, I'll put a link to this video in here and a quick little summary of some of the things in this video. And I think that about answers everything. Oh, as far as phase two mini funds is looking like probably August, September era, which means we might do an accredited fundraise after our warrants, or at the same time as our warrants, somewhere around in February. No guarantees. I don't know that my opinion is once phase 2 begins, I don't know we ever have to raise for HouseHack again. We theoretically could just go from what we have now, warrants, into phase 2. But there are a lot of people that are hitting us up saying, Kevin, the market was terrible in October when you guys last fundraised, and you guys still raised a bunch of money. And we got our JP Morgan credit line, by the way, 25 mil. That's pretty cool. But anyway, we want to invest more because we couldn't in October for whatever reason, but now the stock market's at all-time highs. We want to diversify, whatever. Those are things we're hearing. So we'll probably open that up in February. Though, again, once we get to phase 2, if phase 2 works the way we expect it will, which we don't know if it will, but if it works the way we expect it will, we shouldn't ever have to fundraise again because it's just we're doing wedge deals and then mini funds and wedge deals and mini funds. So we'll see. Anyway, anything else? Talked about auditor, briefly mentioned plane, property management, construction. Oh, the team's getting really good. The training's working to where they're finally bringing me deals, and I'm like, oh, that actually is a really good deal. That takes training to get to that level, and so shout out to the team. They're really kicking butt on that, so very exciting. So there you go. There's a HouseHack update. Thank you so much for watching, and we'll see you in the next one. Goodbye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker.